So, like, do you guys remember when the robos came out? There was this wave of fear that came across the industry. And this is something that Michael Kitsis, who's a commentator, for those who aren't in the business, he's a very high-profile commentator on our space. And he was in the camp that they're not going to have a huge impact. But there's a lot of fear that's going to put massive pressure on fees, especially if you're in the AUM, fees based on assets, business model. And the reality is that the fees have not come down hardly at all over the past decade, but the amount of services and value being delivered has gone up. So people have to do more to justify the fees, the punchline. However, there is a lot of money going into this space, like the robo space, and kind of circumventing the independent advisory model, which I think is super interesting. And but in terms of, is it having a big impact? So I watched a presentation by Chip Rome of Tiburon Advisors, which is an advisory firm to advisory firms. And the scale of our industry worldwide is absolutely massive. Like, it's over $150 trillion in size. It's a wealth management, liquid wealth management space globally. Wow. So one of his points that he was making is that even Fidelity, which is like the largest at 10, 11, 12 trillion dollars, in a $150 trillion marketplace is still relatively small. You're not talking about massive amount of market shares. So his point was, everybody is relatively small. But certainly one of the big trends is this shift from active to passive. And if you're an active manager now, you've certainly got the headwinds against you from this massive shift towards, call it passive or index type investing. I thought that was pretty interesting when you think about the scale. Like, even Vanguard at 6, 7, 8 trillion?
Yeah,
right?
I think BlackRock's around 10, I think, maybe just north of 10. So yeah, even between the three of them, they have, call it less than, a quarter of the global market share?
Yeah, far
Based
less.
on those numbers, yeah.
Based on those numbers. And he said those, along with Morgan Stanley, those are the giants that are. But the other comment that he made is that there's very little new money coming into the system. The whole system that we're in, there's roughly 2% growth, organic growth coming into the system. So most people are kind of trying to chip away at each other's clients, right? And and that's really what's going on at scale right now.
Wow, that's interesting. It's funny you mentioned the just the size of the market and the size of the active versus passive marketplace. And I actually took this information from the, what's it called, the PWL Active Passive Fund Monitor, Ben? Is that what you guys call it? Thanks. Because I was writing this for the book as well. So, and the U.S. is way ahead on this. But in the U.S., passive index assets have now actually surpassed the value of actively managed assets. In Canada, though, 83% of the marketplace is still actively managed products. So the Canadian marketplace at the time that I read this, the Active Passive Monitor, was just over 2 trillion, I think it was. So somewhere around 2 trillion, and passive index type products were about 310 billion versus 1.575 trillion in active funds. So we've got a long way to go before there's like even a seismic shift or a tipping point.
These are fund assets. There are like other non-fund assets that might change these numbers, but this is like mutual fund and ETF assets.
Yeah, well, you'd think non-fund assets would skew towards active anyway, right? Like if
I don't know if that's true, because a lot of, like, if you go to the institutional world, you can very easily have an institution who is managing their portfolio very similar to an index fund, but they're not an index fund because they're holding the securities directly.
I see what you mean.
So,
interesting.
Yeah, I think there's probably more indexing than you might expect in the non-fund portion of the market.
Very interesting. Yeah, Cameron, to your point, I remember in 2015 when Robo-Advisors were the big boogeyman, and there were a lot of people that were like advisors that were really scared that this was going to be so disruptive. And you'd hear it from people too who just don't like advisors, like your days are numbered and like the robots are coming for your job kind of thing. And obviously in hindsight that was kind of laughable, but we're experiencing it again now with AI and ChatGPT. Right? Like people on Twitter just chirp me all the time. Like you're like a robot's taking your job. You better go apply at Starbucks kind of thing. And I don't know. And this doesn't even just apply to financial advice. I don't think the market for human advice ever disappears completely. Like whether it's tax or financial advice or legal advice or, fitness advice or whatever it is. Like I think there's always a market for humans wanting to interact with humans. And sure, maybe the technology gets so good that at some point you can't tell. And I think if nothing else, that will increase it will focus the business into those who offer higher quality services, so it might kind of trim from the bottom. But even with AI these days, I'm not yet worried for our industry or my own job.
Humans are so messy, and AI is going to help us better help humans. But humans by nature are messy, right?
Yeah.
And financial planning is booming. That's
Yep.
the big shift, right? I think we said this a couple of weeks ago. Back in the day, threw in financial planning for free to manage the assets. Now, effectively, Ben, as you say, investments are largely figured out, and the value prop is more shifted towards the financial planning side, and that's exactly what Kitsis has been saying.
Yep.
Super interesting. Ben, what do you think?
Yeah, I think there've been a bunch of cases where everybody thought advisors were going to be done. Like I think even with discount brokerages, everyone's like, well, advisors are done, but the business just evolves. Like what an advisor does changes. You used to place stock trades, and then discount brokers show up, so that's no longer valuable. So the business model shifts.
Yep.
I don't know what the next shift will be. I don't know if robo-advisors changed much other than maybe, like you said, Cameron, it didn't compress fees at all. It maybe pushed people to improve their services, maybe to improve their online offerings. I don't know how much changed the actual services, though. Maybe a little bit more planning. But with AI, like...
What about the general awareness of just a non-bank or non-large firm option for your investments and financial planning? I think there's a lot of people don't even know that firms like us even exist, that this is possibly an option. Like, how can you go outside of the bank in Canada or the big
even
brokerages
people that
in the
know
US?
us, like your experience on Twitter, Mark, even people that know us don't necessarily know what we do.
Yep. Well, and that's largely like Questrade's whole marketing program is it Questrade who's basically like, oh, you're still using Dad's guy? It's like,
Questrade,
you didn't know that there was another option, right? So I think to your point that even just letting people know that that's not the only way to have your money managed, whether it is through like, discount brokerages or robos or kind of independent firms. A lot of people have been with the banks, as you pointed out, Cameron, for decades. Their family's been with them for decades. The loyalty is there. A lot of bank advisors, do great work, but maybe just educating Canadians that there are other options. I think that the robos probably helped accelerate that.
Yep.
And speaking of value prop, I mean, what's up with the new calculator? Can you give us an update?
Yeah, well, so I wanted to actually talk about that in the context of AI as well. Just to your comments, Mark, about whether AI is going to take our jobs. I think it can maybe change what we do, like some of the other stuff that we've been talking about has. But, this new calculator that I'll talk about in a second, Cameron, I tried to use AI to help me code it, and it was absolutely horrific.
Really?
Like completely useless, in fact.
Would you use?
I talked to Jason Pereira about this, and
Would you use ChatGPT to help you write the math and the code and stuff?
Yeah,
Okay.
yeah. Because Jason Pereira told me to. So yeah, I'm coding this thing in VBA. So just use ChatGPT to do it. I said, okay, I'll try that. So tried a bunch of different prompts, and the code it gave me was like a joke. And maybe I was doing it wrong. I don't know. Maybe someone who does software for a living is going to tell me that I was, it's my fault, not ChatGPT's. But anyway, it didn't impress me. So for that type of stuff, for modeling complex financial decisions, I'm optimistic. Maybe it'll get there. Like, I think technology is great, but at least for now, and I know it's moving fast, but for now it's not there. The new calculator that go ahead.
No, I was just gonna say I think it can help with a lot of basic questions that don't involve the modeling, the math, that type of thing. Again, in Dan's book, there's at the end of the book or at the end of one of the chapters, he basically said, I asked ChatGPT this question and here's its response. And it was a very, very simple, 5 questions, should I pay off debt or should I invest? And what debt should I pay off first? And these types of things. And it answered those questions really well. So general logical reason, I think, is pretty good. But yeah, from what I've heard, just from watching programmers and stuff on Twitter, it's got a long way to come before it can do that kind of stuff that you're talking about.
Yep. So yeah, the new calculator is, we had that break-even calculator that for personal investments. So if you own a taxable asset with a capital gain, we built a calculator that people can see online that helps you understand how long you would have to hold that asset to make deferring your capital gain more advantageous than realizing it before the capital gains inclusion rate increases. So that's been out for a while. We did that one pretty quickly after the federal budget proposals were released. More recently, we added to that calculator a little toggle button where you can switch between personal and corporate investments. So now you can look at a corporation and you can see, again, what is your break-even horizon with the corporation. What we've left out of that model is the ability to include how you're paying yourself from your corporation. We talked about this in a recent episode where I kind of talked about some of the modeling that I've been doing on this. We may include that later, and it does matter to the decision. Like you would make a different decision if you're taking a certain amount of money out of your corporation with respect to realizing a capital gain than if you're not taking any money out of your corporation. But it's also a lot more complicated, both to model and to kind of show what's happening in the outputs. So we've done that modeling. We may release it in our public tool, but for now, we're just going to keep that portion of it as an internal tool.
It's pretty cool though. Like I've gone through the internal kind of training on it, but yesterday Ben helped me use that calculator in conjunction with the financial planning software that I use for a particular client who needs to make this decision. And Cameron, as you mentioned, we're all going away, but I leave tomorrow. I come back June 24th. And so I booked this trip, of course. And then they propose the changes. And I'm like, great. I literally come back like the evening before the changes are going to go into effect. So for my clients who may be affected, I've had to kind of figure this out before tomorrow. So Ben helped me with the calculator, and it's quite impressive. Like the amount of thought that's gone into it, and just the way it presents sort of where the break even is and how sensitive it is to some of these inputs and expectations, right? So it's just such a complex decision, I think, for a lot of people, that without this type of modeling, like there's going to be mistakes made around this for sure.
I think it's unfortunate how this whole thing's coming down. I'm not even talking about the policy, but it's more the rush and the timing and the complexity around it. This is very complicated stuff.
Mm-hmm.
Also for the tax department too.
Oh yeah.
Very complicated.
It's complicated when we have no legislation, no draft legislation to go on. So it's like capital gains rates increasing, but we have zero details on how it's going to work or whatever, and that can change what people might want to do. So it's a really, to me, it feels, I don't want to get political at all, but it feels irresponsible.
Well, we're living it, right? Client situations, other professional situations. There's this massive rush to come up with an answer. You're basically flying blind. So, yeah. Good to move on, Ben. You want to talk about private credit and some of the feedback you got in the community?
Yeah, I will mention that. I do also want to say that we did do a Money Scope episode, Mark South and I, on some of the stuff we just talked about. So we talked about the modeling that both Mark South and I have done on capital gains and corporations. We talked about individuals too. But that episode came out last Friday, I think, when this episode comes out. Is that right?
Yep.
Anyway.
Nice, basic, easy listening stuff.
Yeah, that was a pretty intense episode.
Just good background chatter.
Mark South was very excited to have his first 3D chart that he's ever made, because that decision requires 3D graphs to understand what is happening.
That sounds like something he'd get excited about.
Oh, he was excited. I was too, though. We were both super excited.
Yeah.